Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the money world. So, SideChannel Incorporated just dropped their latest quarterly report, and let's just say their going concern status is, well, it has got some explaining to do. This is their version of a regular checkup, a Form 10Q covering the 3 months ending the 31st of December 2025. We are going to dive into what's really going on behind the numbers. Before we jump in, if you like straightforward insights from these dense corporate filings, hit that subscribe button, and hey, we have a growing community on Discord. Link in the description below, where we break down these reports and more. Let us start by looking at the company's financial health snapshot. On the 31st of December 2025, SideChannel had total assets of about $2.9 million, down from $3.4 million at the end of September. That might sound like a lot of money, but remember these are thousands. So we are talking about a drop from $3.4 million to $2.9 million. On the flip side, their liabilities also decreased slightly from $1.3 million to $1.1 million. This means their total assets, everything they own, are down. This also means their stockholders' equity, which is basically what is left for the owners after paying off debts, also went down. It was $2.1 million in September, and now it is $1.8 million. Now let's talk about their income statement, how much money they made and spent. For the 3 months ending the 31st of December 2025, SideChannel brought in $1.77 million in revenue. That is a bit less than the $1.9 million they made in the same period last year. So revenue is down about 7%. They did manage to improve their gross profit, which is what is left after paying for the direct costs of making their product or service. Their gross profit increased from $874,000 to $909,000. And importantly, their gross margin, that is the percentage of revenue that is gross profit, jumped from 45.8% to a much healthier 51.2%. This is good news. It means they're holding on to more money from each sale. But here is where it gets tricky. While their gross profit is up, their operating expenses shot up. Total operating expenses went from $1.08 million to $1.3 million. That is an increase of over 21%. This means even though they're making more profit on each sale, they're spending a lot more to run the business. Specifically, their selling and marketing expenses more than doubled, going from $267,000 to $457,000. This sounds like they are trying to push more sales, but it is a big jump. All this added up to an operating loss of $400,000 for the quarter compared to a loss of $206,000 in the previous year, so they are losing more money operating the business. And when you add in taxes, their net loss for the quarter was $396,000, up from $95,000 in the same period last year. This is a significant increase in their net loss, meaning they are bleeding cash faster than before. Looking at the statement of stockholders' equity, we see the impact of these losses. Their accumulated deficit, which is the total of all their past losses minus any profits, grew to over $21 million. This shows the company has a long way to go to become profitable. Now, let's talk cash flow. This is the lifeblood of any business, and SideChannel's cash flow from operations looks concerning. For the 3 months ending the 31st of December 2025, they used $570,000 in cash from their operations. This is a big jump from the $75,000 cash they generated in the same period last year. They're not just losing money on paper, they are actually burning through cash. Their cash balance at the start of this quarter was about $1 million. By the end of the quarter, it had dropped to $495,000. This means they burned through more than half of their cash in just 3 months. This brings us to a crucial point in their report. The company itself admits they have serious doubts about their ability to continue operating as a business for the next year. They call this a going concern assessment. They point to their recurring operating losses, negative cash flows from operations, and limited cash on hand. They also mention they have no credit lines available, which means they can't easily borrow money if they need it. Normally, this kind of statement would send shivers down an investor's spine. It is a big flashing red light saying beware. However, the company says they have plans in motion to fix this. They're planning a cost reduction program to save about $930,000 a year, which includes cutting staff and reducing spending. They also plan to seek additional funding through selling more stock or taking out loans. They believe these actions will give them enough cash to operate for the next year. But as you can see from their cash burn in the last quarter, this is a very tight situation. Then there is this interesting detail. On the 22nd of January 2026, just before this report, they did a reverse stock split. They combined every 52 old shares into one new share. This usually happens when a company's stock price is very low and they want to make it look more substantial or meet stock exchange requirements. They also made sure to round up any fractional shares, meaning some people might have ended up with a few more shares than they would have otherwise. This split doesn't change the overall value of the company, but it does reduce the number of shares out there, which can sometimes make the stock price appear higher. However, it doesn't magically fix underlying business problems. Under their accounting policies, they've told us they operate as a single business segment. This segment is all about cybersecurity solutions, which they break down into two main areas. VCISO services, that is like a virtual chief information security officer on demand, and then cybersecurity software and services, which includes their Enclave product. Last quarter, VCISO services revenue went down significantly by about 29%, but their cybersecurity software and services category grew by about 30%. So it looks like they are slowly shifting away from the services and towards their software. This shift is interesting because the newer software products likely have higher profit margins, which might explain why their overall gross profit margin improved, even though their total revenue dropped. Looking at their deferred revenue, which is money paid in advance for services, it decreased from $801,000 to $677,000. This indicates they've been earning more of that previously paid revenue this quarter. They also mentioned some risks. No single client makes up more than 10% of their revenue, which is good, but they do have 3 clients who account for more than 10% of their accounts receivable. This means if those 3 clients don't pay up, it could be a problem. Also, on the cash side, while they have FDIC insurance, they had about $207,000 in uninsured deposits at the end of December 2025. Not a huge amount, but it is worth noting. They're also granting stock awards to employees for the quarter ending the 31st of December 2025. They granted about 32,000 restricted stock units, or RSUs, to new employees. These are essentially shares of stock given to employees over time as a bonus. The total stock base compensation expense for the quarter was $100,000. While this is a cost to the company, it is also a way to incentivize employees. Now, this next part is quite significant. The company acknowledges that their disclosure controls and procedures were not effective. They have identified several material weaknesses in their financial reporting. This means their internal systems for ensuring accurate financial reporting are flawed. They lack formal accounting policies, clear procedures, and importantly, enough qualified staff with the right expertise in accounting rules to handle complex transactions and ensure timely, accurate financial information. As a smaller reporting company, they also mention a limited staff and budget to test these controls. This is a pretty serious admission. It raises questions about the reliability of the financial information they are providing. While they say they are working on fixing these issues, it is a major red flag for anyone looking at this report. So, what is my take on SideChannel Incorporated's latest report? Well, the company is in a precarious position. They are burning cash at an increasing rate, and their revenue, while seeing growth in their software segment, is overall declining. The improved gross margin is a positive sign, suggesting their shift towards higher margin software might be working, but it is not enough to offset the rising operating costs and the overall net loss. The going concern warning, coupled with the admission of material weaknesses in financial controls, paint a picture of a company struggling with its operational and financial foundation. They are actively trying to cut costs and secure more funding, which is a necessary step. However, the success of these plans is uncertain. The reverse stock split, while a cosmetic change, doesn't address the core issues of profitability and cash generation. The story here is one of a company trying to pivot its business model towards software for better margins, but facing significant financial headwinds and internal control challenges in the process. The increased spending on sales and marketing suggests an aggressive push to gain market share, but it is currently not translating into top-line growth. The lack of liquidity and the reliance on future financing make this a high-risk investment scenario. What do you think about SideChannel's situation? Are there costs, cutting and funding plans enough to turn things around, or is this a company heading for trouble? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a like, and if you want more of these deep dives into corporate filings, make sure to subscribe. And don't forget to join our Discord community. The link is in the description. We'd love to have you there. Thanks for watching, and we'll see you in the next one.